traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Thursday, the 21st day of August 2014, and this is the daily report for gold and silver. Except for palladium, which is showing a dramatic rise, another $12 record highs in palladium, we have the precious metals markets lower and strongly lower across the board. Gold, although off of the lows of the day, and the low today is $12.7240, is trading off roughly $14 to $15 lower. The high $12.8840, currently trading roughly at $12.78. Silver also trading lower, off about 3 cents on the day, so nothing like the type of decline that we're witnessing in gold. Low on silver, 1921, the high 1957, currently trading above the 76% retracement level at 1944, 1943 in that area. As I said, only putting it off about 3 cents on the day. More on silver towards the end of the show. Absolutely no doubt, today's trading activity has put tremendous downside pressure on the precious metals market, specifically gold. Gold trading substantially lower, as I said, off about $14, $15. We're looking at a daily chart. This is COMEX Gold, and I want to take a look and talk about whether or not we have created any kind of long-term damage in terms of any of our either Elliott wave counts or current models factoring in this most recent and dramatic decline. Of course, we broke through the low that really to me was a pretty critical low. That's sitting at around 1280. Now realize 1280 is a 61% retracement, and it is a 61% retracement of this dynamic rally, this $100 rally. When we look at the rally which began in 2013, beginning of 2014, takes us through March of this year, that's a little bit different. The 61% retracement there is 1261. Now, what is interesting is, you know that I look for a thing called harmonics in Fibonacci retracement. And simply put, when we look at harmonics, what we're looking at is different time cycles, different particular points in which we plot fib retracements, and then we look for areas in which they cluster together. And we are absolutely getting our harmonics at around 1261 to about 1265. Why do I say that? Well, we have a 61% retracement of this long rally, and at the same time, we have a 76% retracement of this shorter rally, all kind of clustering right at around 1260. A move below there could in fact signal some long-term damage on a technical basis on our charts. However, as we look at this market, we still, as I said, we are absolutely categorically below 1280, but this, to me, this 1265, 1261, that would be a point in which, if in fact we saw the market break through that particular area, that we would have to look at any kind of current model that we had that had any kind of bullish tendency and absolutely reevaluate that. Up until that point, we could see this market, which we had a $100 rally, it gives back 76% of that and then moves higher. That is still plausible and still falls within the model. However, if we break below the 76% or the 61 for this longer rally, that in fact is, I believe, inflicting some long-term damage. Now, the damage that we have inflicted at this point when it broke through tells us that categorically we have not completed, if this model is to still hold any kind of weight, this subcount or wave 2. The way that we were viewing a potential model within our Elliott wave count was a wave 1, an A, B, C, completing that when we hit the 61%. And then as the market, of course, went up, we were looking at that as a new or a third 3 out of 3. However, with this most recent decline, we have to look at that model and factor in these pricings. And when we do that, the only thing that would make some sort of technical sense right now is as follows. And that is, we see this market move up, and we are still obviously in some sort of corrective wave count where this would be something like an A, a B, and then we're still in the C. C takes us to 61%, which is the larger of the two waves, and then begins to move up. The jury is still out. The fact of the matter is that recent comments made in Jackson Hole has brought the investment community and the public at large to be under the current belief that interest rates might rise sooner than expected. The economy is picking up steam, and how they deal with tapering as well as controlling interest rates are very, very much hinged upon the economy and jobs. So I take this with a grain of salt. However, this recent move in the market has absolutely been a small game changer because we absolutely broke below this particular point in which we really looked at as a potential bottom. The other thing that it does is when we look at our series of bottoms, 1180, 1240, this 1280 doesn't hold anymore. So any kind of a move to this point of 1265 would still give us a higher low. However, at the same time, and this is something that we talked about a little bit yesterday, we are definitely seeing more than anything else a compression in range. If we take a look at these recent highs and we peg a resistance line amongst that, and then we fix our recent lows, what you will see, and of course we're fixing our low here and then this low at 1240, we are still within the confines of a compression triangle as long as it stays above this particular support level, this resistance line, which is created from these two data points. So have we caused long-term damage in the market? Well, not yet, but we are at the foothold, the doorsteps of that possibility, because if we look at where this particular low has come in and we look at that in the context of this possible compression triangle, we are truly getting the market testing the range. So where does that leave us? Obviously, tomorrow is an important day because we will have comments made by the new chairman, Yellen, as she concludes the Jackson Hole Symposium that is going on. We will get a real sense for where she believes the economy is going and maybe some more hints as to if interest rates will be raised, what kind of timetable might be involved. There's no doubt we are under pressure. We have been without any position in the market. Should we have been short? Well, obviously, when you look at the market, it has gone lower and that would have benefited us. But most importantly, we certainly didn't get caught long in the market as this market fell under pressure. So in that regard, I feel comfortable in saying that we need to see how the market reacts should it continue under pressure. We have a couple of different areas that we want to look at. 1265 being one area. And then, as I said, as we look at the projection that is created from these lows, this low here and this low here, it comes up above 1265. Call it, say, 1270, where they would intersect. I think the low today was 72 or 73, so we have remained above it, but not by too much. So what about silver? Well, when we consider the kind of dramatic downside move today that we saw in gold, and the fact that silver is only trading 3 cents lower first, secondly, the fact that silver is trading above 1935, we certainly got no follow-through from yesterday's small rise in the market, and if anything, we're still seeing a stair step down, even though we're getting alternating candle colors in the straight candlestick. We certainly would still be all red if we looked at the Japanese average charts. The real key to me is whether or not silver can hold above 1935, and of course that's on a technical basis. The one thing that we have to look at is the fact that we had the equities markets moving to higher highs on the day, picking up back into a rally mode, and I think we saw some spillover in silver, but unlike palladium, which has supply issues, we didn't see any kind of rise in silver. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.